I kind of start off my section just kind of prefacing it with, obviously it's been a pretty rough week of price action, in terms of, BTC and the equity markets. We had some big reversals in the indexes earlier in the week. We had some unfilled gaps on the Nasdaq from June 9th, June 10th. So that kind of turned into resistance. We ended up reversing there. Obviously, yesterday was the last day of the month and the quarter. So a lot of talk online about the S&P and the major indexes performance for the quarter and for the first half of the year. So I kind of start off the newsletter talking about that, and I kind of went a little bit deeper with that than what I've seen a lot of people talking about online. You hear a lot of people saying, worst first 6 months since 1970. So I looked at all of the S&P's 6-month data going back to 1871. So what I found is that 2022 was the fifth worst first 6 months for the S&P 500. And also, there's a thread that I did with all these charts linked up or pinned at the top of this space. So if you want to look at some of those, they'll be sitting there. So it's the worst since 1970. It's the fifth worst of all time. The only years that were worse were 1932, 1877, 1962, and 1970. And those are some of the worst economic periods that the United States has ever seen. So 1970 I'm talking about the first half of these years. 1970 was the beginning of this 69 to 70 recession that kind of came following the Vietnam War. 1962, we had this flash crash, also known as the Kennedy slide, which came following the 60 to 61 recession. Obviously, 1932, we're in the midst of the Great Depression. In 1877, we're in the middle of what was called the Panic of 1873, which was a collapse in the railroad industry, which was the second longest recession in U.S. history, behind only the Great Depression. So obviously not a great sign to see 2022, ranked with some of those disasters. And that kind of puts the first half of 2022 in the 99th percentile for worst starts to a year for stocks. So I found that interesting, but I wanted to take it a little bit further. So if we look at the second half of all those years, what you see is that in 1932, the S&P was up 43% in the second half of the year. 1877, it was almost 20%. 1962 was 15%. In 1970, it was almost 27%. So, I thought that was super interesting, right? The second half of those years were all positive and, double digit positive. But, when you look even more deeper into it, it doesn't say that without a doubt we're going to be green to end the year. And in fact, I would personally would wager that it won't be green to end the year. And the reason for that is, so only in 1962 of those 4 years that are, worse than 2022, only in 1962 was that red first 6 months following a green second half of the previous year. So if we look at the other periods, 1970, 1932, 1877, all of those were on those terrible first half of the year was on the tail end of many red 6-month periods in a row. So for 1877, the first half was the fifth red 6 months in a row. 1932 was the fourth red 6 months in a row, and in 1970 it was the third in a row. And as I mentioned, 1962 was called the Kennedy slide. It was a flash crash. And it was one of the shortest bear markets that we've seen. And so you could consider it an anomaly in the stock market. So what that tells me is that the likelihood of this being a one and done negative 6 months after being down over 20% is fairly low. And also, if you look at the 2 years whose first halves were bad but slightly better than 2022, so number 6 and 7 on that list, would be 1907 and 1893, and both of those years were similar to 2022 and 1962, in that they were coming off of a previous 6 months that was green or essentially flat, and both of those quarters had negative second, or both those years had negative second halves of the year. So just something to keep in mind. Kind of moving on, but I wanted to discuss some research that I did on the follow through day, which is a concept I've discussed a lot in the newsletter, and I'm not going to go through it here. I've discussed it a number of times, and if you go into the newsletter, I linked a past week's newsletter where you can go to read more about that. Also, there's a in the thread that's pinned up top. I wrote a thread on this concept earlier in the week, so if you want to go read that, I discuss all of that also. And I'm not necessarily going to get into the details of what I discuss here in this study. In this space, I think you guys should go read it on the newsletter. It can be maybe a little bit dense, but I think it's super cool, and it just kind of reiterates the point that the fall through day is a pretty good signal of a time to potentially start getting long the market. Of course, you have to be managing risk with that. And so I conducted this study using a portfolio that essentially buys using a set of criteria that includes the fall through day, and you would be outperforming the market over the 21st century. So, moving on from that, in the stock market, we're seeing these Chinese names that are leading the pack in terms of, relative strength and price action, which is, these stocks are just pricing in the reopening of China and potentially the resolution of these supply side issues, which, could and should spill over to the U.S., which I think is interesting and something to keep an eye on. But of course, history tells us that these Chinese-owned companies that are listed in the U.S. have a history of, dishonesty and ending in kind of disaster. If you remember, Luckin Coffee in 2020 is the most recent example. So you have to be really careful. But I think from a trading perspective, their charts are pretty hard to ignore. So if you look at names like LI, DQ, JKS are some of those leaders. And then you also have leadership coming from some biotechs and some medical stocks like LNTH, Don, and IOVA. So just a couple things to keep in mind there in terms of leadership and sectors of the market that have been working. And then looking at the Nasdaq Composite, last week we retested those this support level from the first correction that we had following the COVID 2020 lows. So September 2020, when we made that first relatively significant correction, and the Nasdaq retested that level last week and was able to hold it. But this week things don't look amazing. Right, on Tuesday, the index was down around 3%, and it undercut its 10 EMA, 21 EMA on the daily, which obviously wasn't a great sign. And we've kind of seen that downside continuation for the remainder of the week. So to me, and volume's been relatively high as well. Yesterday we were right around 50-day average with the index down. So to me, it looks like we would potentially retest that support level again. So on the bond side of things, moving on, we've seen this downtick in yields this week, which is definitely interesting, and they're down for the second week in a row. So if we look at the 10-year Treasury yield, at the time of writing yesterday, it was sitting right around its 50-day moving average. Today, it's broken down below that. Yields are down another 4% today on the 10-year. But if we look at the last rally that we had in the bond market, so for those who aren't familiar with bonds, right, yields and bond prices have an inverse relationship. So when you see yields falling, that means that bond prices are rising, so people are buying bonds. So last time there was a rally in the bond market, or yields sold off, they sold off for 3 weeks in May, and they found support around, for the 10-year, found support around that 50-day simple moving average. So I was kind of speculating that could be a potential place that we would see yields bounce. But looking at it today, they're breaking through that level. And I'm not exactly sure what the reasoning is for this. There's obviously a ton of reasons. But you could say that equities. So equities generally sell off when yields are rising, and when yields are falling, it's generally bullish for equities. But that hasn't been the case these last couple of weeks. But there is an argument to be made that if yields continue to fall, equities could follow the bond market's lead in terms of higher prices. And people call the bond traders the smart money. So generally the smart money tends to in the bond market tends to lead, and then the equities will follow suit behind. But I think it's it's kind of anyone's game here, and it's anyone's guess. And also, you see equities falling and the dollar's rising at the same time, which is generally a bearish signal. So, what's going to happen in the bond market and the equity markets is It's interesting, but I think it's a little too early to completely make a prediction about what's going to happen there. So moving on, I wanted to talk about the macro front just a little bit. So obviously, some big news this week that was popular on Twitter was that the Atlanta Fed revised their Q2 GDP estimate to become negative. So it's at their estimate for Q2 GDP would be -1%, which would put the U.S.'s GDP at negative for 2 consecutive quarters. And a lot of people use that as a indication of recession, right? If you have two consecutive quarters of negative GDP, that would mean you're in a recession, and that's just not true. Um, and even if the GDP number, which Q2 GDP number, which will be released on July 28th, even if that does come in negative and we have 2 consecutive quarters, it does not necessarily mean that we're in a recession. A lot of times those, recession and 2 negative quarters do align, but it isn't like that's not the set in stone, criteria. It falls on the National Bureau of Economic Research, or NBER. They are the ones who declare a recession, if you will, and their declaration, or if you want to call it that, takes into account a lot more than just GDP. So they have three kind of subsets of criteria. They have depth, diffusion, and duration. And also, these charts that I'm about to discuss are in that thread up top. So you have depth, diffusion, and duration. So depth means that the retraction in the economy must be very significant, right? It has to be deep. Diffusion means that it must be spread widely across lots of different sectors of the economy. And duration means that the retraction must be across many months or multiple quarters. So the argument as to why the U.S. may not be in a recession right now is that we haven't met the depth criteria. And there's a few metrics that would back that thesis. The first of which is that we need what NBER looks for is a decline in gross domestic income. So that kind of goes alongside GDP, and they're very similar. The difference is that gross domestic income, or GDI, measures all the income earned by producers of goods, while GDP is measuring the value of the goods that they're producing. So, ideally, in a perfect world, GDI and GDP would be equal, but in the real world, that doesn't happen very often. So we can look at them as separate entities to kind of judge what's going on a macro front and a production side. So what NBER is looking for is a prolonged contraction in GDI, and that's not what we've seen of recent. Right, GDI was up for the first quarter of the year, and obviously that Q2 data point is going to come alongside GDP. So it'll be interesting to see, exactly how that plays out. But furthermore, we can look at unemployment, because unemployment and GDI are relatively similar, right? So if producers are earning less income, then they can't afford to take on as many employees, and an unemployment rate will rise. So we have this increasing GDI over last quarter, and unemployment has essentially been unchanged. So we've been at 3.6% unemployment for the last 3 months or so, or it was for March, April, and May. It's all been 3.6. So there isn't an argument to be made that that's this rounding out of a bottom in the unemployment rate. But until we see higher unemployment and lower GDI, it's unlikely that NBER is going to come out and say that we are officially in a recession. And 2 declining quarters, as I mentioned, is not a signal of recession. But yeah, that's about it. All I have on that, macro equity bond front. Of course, I always discuss crypto exposed equities as well in the section. I'm not going to get into that in this space, but I discussed I discussed MicroStrategy, and then of course, as always, I included that table which compares the weekly performance of a bunch of crypto equities to that of Bitcoin and to WGMI, the mining ETF. But yeah, that's all I got.
Well said, Blake. That's a lot of content. If anybody walked in late, make sure to check out the newsletter and read that and take a further look. Joe, well, you guys got any comments on the macro side?
No, nothing from my end. I think that was, well said, Blake. Obviously a lot going on the macro front, so it's what's driving markets right now. I think you covered it well.
Thank you, sir. Go read the newsletter, guys. There's obviously a lot more information there than I'm covering in this space.
Joe
Cool.
or Will, you want to go on the mining or on chain?
Yeah, sure. I could go ahead and dive into some Bitcoin centric stuff and then pass it off to Joe for the mining stuff. I'll just kind of run through these things from a high level just because there's like a shitload of different metrics in here, and so I kind of want to keep it as brief as possible, but while at the same time like covering a lot of ground. So, you know, to start off, this has been a pretty horrific month. There's no real way to kind of get around that. It's been the worst quarterly performance for Bitcoin ever, which is pretty remarkable. The Q2 candle closed yesterday down 56%. It's pretty brutal. If we look at like the 2 month returns of BTC, it's one of the worst months on record as well. Monthly, I mean, really, anyway, you kind of want to chop it up, and a lot of the kind of I guess negative effects that we've seen on the market have all kind of stemmed from this contagion that everyone's kind of beat like a drum for the last 2 months and talked about. It all kind of started with Terra Luna. I'm not going to rehash that whole thing, but obviously we saw the death spiral of UST, which caused the collapse of the Luna token, and with that, we had kind of said in the newsletter, and I had made this post at the beginning of May. I said, the question now is where will the contagion show up from the meltdown? How many crypto funds and projects were holding UST? How many custodians were lending clients funds in Anchor? And, I think one of the biggest hit venues out of all of that, we saw Celsius, but the biggest it seems like so far has been Three Arrows. I think a lot of us, myself included, kind of assumed that Three Arrows had proper risk management. That stuff's been talked about on numerous podcasts, and so I don't want to rehash too much of that. But kind of from a high level, what had happened was I think Three Arrows was already down a fair bit on the GBTC trade. They'd locked themselves up in a lot of kind of long-term alt positions. And then recently with the Luna thing, they had taken payment for BTC, and while Luna was acquiring, their BTC reserves, they'd done a deal with 3AC for I think it was like 500 mil in Luna for BTC in exchange, and essentially all of that became worthless. And then at the same time, they were capturing, in a way, kind of like a basis trade on the 20% yield offered by Anchor. So they would go to different lenders, borrow fiat, and then deploy that into Anchor, get the 20% yield, sell that back to fiat, give that back to the lenders, and keep the difference. And so I think they kind of got caught with their pants down on that trade as well. And the blow up of 3AC obviously is spread to pretty much every major lender in the space. Some have been more prudent with their kind of risk management than others. We've seen some like Voyager, not even over collateralizing the loan. And you got some like BlockFi who did over collateralize but still took a massive hit on their balance sheet. Haven't heard from Genesis. They've been awfully quiet, but we can assume they've taken a fair hit as well. Then Celsius obviously taking a massive hit. I think the worst of all of them because they were also kind of like degenning on different DeFi protocols and things like that. Rumor is that they've taken a $2 billion hole on their balance sheet as well. And so with that, these effects have caused a lot of forced selling in the market as some of these lending venues, look to kind of verify the solvency of the different borrowers as well as, then those borrowers have to go into the open market and some of them have to sell tokens to, post collateral and post margin for their loans. And with that, I think you've seen a lot of forced selling on that front as well as, it's been the end of the month. At the end of the month, we tend to see fund redemptions. Um, Also, just kind of like quarterly rebalancing at the end of the second quarter that just closed out. And so one of the things that I've been looking at as kind of like a proxy for this forced selling has been if you take the market capitalization of Bitcoin, market capitalization of ETH, and then you do a correlation of that to the rest of the crypto market. So, the aggregated crypto market cap subtracting out Bitcoin and ETH. You've seen this interesting quote unquote like decorrelation or decoupling over the last week or so. That's been quite, kind of strange. One of the sharpest kind of decorrelations of those two that has ever taken place. And to me, what that illustrates is that people are having to sell off Bitcoin and ETH, not because they want to, but because they're the two most liquid assets. I think the altcoins for a lot of these large funds, they just don't have the liquidity for them to get out of the position. And so, people are having to sell Bitcoin and ETH if they don't want to, but because they're the only tokens that really have any liquidity in this market right now. And so that's kind of what I've come to a conclusion as to why this correlation has kind of fell off a cliff. You can see other measures of capitulation, which we'll get into in a moment. But one thing I did want to touch on while we're talking about all the lending stuff, one interesting metrics I've noticed lately has been the what's called the exchange net position change. Looks at the 30-day change in the exchange balances, so the centralized exchange balances. And over the last week, we've seen the sharpest 30-day net change in the exchange balances ever, like in all of Bitcoin's history. To me, I think it's kind of questionable as to kind of at least in the short term, what the price impact on exchange balances have been. I think just the market's becoming more nuanced to just assume like, okay, coins are coming off exchanges. That means people are buying. Coins are coming onto exchanges. People are selling. It could be people moving coins onto exchanges to post collateral or whatever it may be. And coins could be coming off exchanges, which appears like someone's buying, but it could actually be people taking coins off exchanges to short on a different venue, or it could be used for a variety of different things. So anyway, with that kind of like being said, I think a large portion of this has been people realizing that at least in this current market state, you can't fully trust some of these centralized entities, like these lending platforms, custodians, and exchanges. And so I think that's been at least in a large way a driver of a lot of these outflows from exchanges that we've seen. And of course, for a lot of the people who believe in the hardcore ethos of Bitcoin's decentralization, Bitcoin being a sovereign bearer asset, like all these types of things, that's of course good. And I think if you do have your capital deployed on these exchanges or lending platforms, it doesn't hurt if you're able to and feel comfortable taking self custody of your assets to do so, at least in the short term, until the dust settles. So back to the capitulation stuff, we talked about like the declining correlation between BTC and ETH and the rest of the crypto market, which indicated potentially some forced selling. Other on-chain metrics also indicate this. Like if we look at, for example, net realized profit loss, even if we do like a 7 or 14-day moving average, we've seen the deepest drawdown in that in Bitcoin's history. We look at things like NUPL, which is net unrealized profit loss. That's on par with the bottom of the 2015 bear market, bottom of 2018, lower than March of 2020. All these kind of historical bottoming areas for BTC. SOPR, which looks at kind of the difference in when coins were last moved versus when they're moved now. So you can look at a UTXO, their realized price, which is the price that they were paid, versus the price that they're then moved now. Of course, there's a bit of an assumption there in that you're assuming once they're moved again that they're being sold. But I do think in aggregate it does serve as a good proxy for that activity. That's at the second lowest that's ever been, only trumped by the bottom of the 2018 bear market. So more capitulation signals, and then the last one would be on the mining front. I don't think you've seen full-on capitulation from miners, but one of the things we've talked about for a while is miners are, and Joe, I don't want to steal your thunder here, so maybe I'll pass it off to you for a bit. But I think essentially you're long Bitcoin price, you're short hash, and you're short difficulty. And so over the last few months, what we've seen is that price has been obviously declining. We've got the worst quarter performance for BTC's price ever. While at the same time, you've seen hash coming online, and with that difficulty rising. So if we look at something like price per terahash, we've seen that down at levels not seen since late 2020, and that as well as you throw in energy costs rising, really has put a lot of pressure on miners' margins. And Joe, maybe I'll pass that off to you without, covering your whole section here, but we have started to see some early signs of, hash coming offline and things like hash ribbons, and starting to see some coins moving on to exchanges from miners and on-chain data as well. Before I move on, maybe I'll pass it off to you for a second to talk about that in a bit more granularity if you want.
Yeah, for sure. So, I mean, first off, I think what you said earlier about the importance of taking self custody right now with things that are going on with Celsius, BlockFi, and all these other, whether they're exchanges or crypto lenders, it's never been a more important time to like realize, you know, when you have Bitcoin, if you have it on Coinbase, you have it on BlockFi, you have it on Celsius, you don't actually have Bitcoin, right? You have an IOU for Bitcoin. To really actually have Bitcoin, you need to hold your own private keys to that Bitcoin and then use your own node to verify that like you actually have that UTXO. So yeah, great points there. For mining, I'll just quickly touch on it and let you carry it forward. But you're pretty much exactly right. Like miners are long Bitcoin, short difficulty, right? And they're also short energy costs unless they were smart enough to lock in a fixed rate over a certain amount of duration. But yeah, I mean, miners are definitely struggling. I don't want to go too far in depth into my section unless um, if you wanted to continue forward with yours. But if you don't want to continue forward with yours, I can happily go through the rest. But so far, what you said, was spot on.
All right, cool. I don't want to start going all over the place. So I'll just finish. I have like a few more things I just want to run through and then pass it off to you, and then we can wrap things up. Just kind of making the point after talking about the miners that, by several measures, we look at just the, valuations coming down in some of these companies like BlockFi. We saw that bombshell yesterday that, I don't think it's fully true, and perhaps was missing some of the nuance of the deal, as the CEO of BlockFi came out and said that them being sold for 25 million wasn't entirely true. But it is pretty clear that they're in trouble, and they're likely going to be acquired for FTX for significantly less than their last round that they raised at whatever, like 3.8 billion. So you're seeing some capitulation in the private markets. Again, you're seeing capitulation from on-chain measures. You're starting to see some capitulation from miners. And then also some of the metrics that we described to look at what appears to be forced selling of BTC and ETH compared to the other assets that potentially indicate some fund redemptions and things like that. So I think across the board, you are starting to see a lot of capitulation in the crypto market. The question, I guess, a lot of people would say, well, have we seen capitulation in the equity market? Have we seen credit spreads blow out? Have we seen the VIX spike? And I would maybe pass it back off to Blake if he wanted to talk about those things. But I think part of the the reason why we put this letter together and separated into these different sections is I think it's important to understand these Bitcoin centric things in context of the macro, and it's kind of up for you to describe the weighing that you give to these things, and relative to the current macro situation, which of course unprecedented, but I think you can get into dangerous territory saying perhaps this time is different ever. And across all of these Bitcoin centric kind of metrics, we're in deep value area. We've seen a lot of capitulation. You've got Nouriel Robini and Peter Schiff dancing on her grave. Mainstream media coming out saying everything's a scam. All the typical bear market bottoming accumulation type of signals. And so I think at a minimum, as kind of a long term allocator, you know I think it's an amazing time to start picking up some BTC and averaging in. And, of course, if you're in the camp of, wanting to wait for kind of the broader macro situation to clear up, of course, that's absolutely prudent. But, I think for someone who has kind of that long-term conviction and is building a 3 to 5, year plus type of position in BTC, I think this is an incredible time to allocate. I mean, just, one other chart to illustrate this, like, for example, Bitcoin's only ever traded below this far below its 200-day moving average and below its realized price, which is essentially like the aggregated cost basis, for less than 3% of all of its existence. So that just kind of goes to show how unprecedented these current valuations are for Bitcoin. We've only ever been below its 4-year trend 3 times in its history. The bottom of the 2015 bear market, March of 2020, and now, we're again below realized price, which has only happened 3 other times in Bitcoin's history. I mean, I could go on and on and on. I don't want to just start dishing out a bunch of random metrics, but I think across the board, it's very clear that on a relative basis, Bitcoin is in this kind of very deep value zone, and I think any long term investor should be considering at least averaging into these areas, and then again, perhaps potentially waiting for some type of clear signal from a macro perspective to allocate heavily, but. Yeah, I mean that's kind of the high level of everything that I had said in the report this week.
Will, I'll just jump in real quick talking about the capitulation stuff on the on the traditional finance markets. I would agree that we haven't seen full blown meltdown like you saw in 2020 and in the financial crisis in 07 and 08. But that being said, everyone on Twitter and everyone on everywhere is kind of saying that we haven't seen true capitulation, right? You hear it like a million times, and to me that kind of feels like maybe we won't. um Normally in the markets it never does what you're expecting, and when every market participant is expecting some sort of meltdown, the chances are you might not see it. But to me this market it feels a lot more like almost like a later in the 2000 bubble, where you just kind of have this slow bleed over the course of months and years. It's not like the 2020 market, where you saw the Nasdaq down 11% in a day or whatever. It's more that slow bleed, and capitulation over time. And that being said, I mean this is like one of the toughest markets from an equity side of things, that we've seen in a while. Obviously, what I talked about with the first half of the year being the fifth worst of all time. I would argue that we've seen a lot of capitulation. It just hasn't taken the form of massive red days where we're down double digit percentages, and the market's blowing circuit breakers and things like that. And yeah, I mean we haven't seen the VIX at historically elevated levels. We haven't seen the put call at historically elevated levels. So I'm not necessarily trying to argue that we're due to bottom here, although it's certainly possible. We could bottom at any time. The bottom could already be in. Obviously, the macro situation is sort of unknown and a little scary for investors. But the markets are forward looking, right? The stock market and the bond market is forward looking, right? It takes into account all information that is available to it and prices that into the future, right? So if people are expecting the Fed funds rate to be at 3% by the end of the year, or whatever that estimate is based off of their current hike schedule, the market isn't going to wait for interest rates to be 3% before acting on that information, right? It's going to immediately start pricing that in. So markets will bottom before the economy does, or before the Fed maybe reverses course in the future. So it's certainly something to keep an eye on. If we started to see mass capitulation on the equity side of things, obviously that would be a signal that we could be even closer to the bottom, right? But I would argue that we've seen a fair amount of capitulation with the indexes in bear market territory, and Bitcoin 60-70% off its highs, whatever it is.
Yeah, Blake, that was fantastic. I can transition us to Bitcoin mining now, and just how mining relates to the Bitcoin market overall as well. So, like Will mentioned, miners are kind of starting to capitulate a bit. We've seen public miners, and I've covered this in past week's newsletters, but public miners have started to sell not only some of the Bitcoin that they're currently mining on a day-to-day basis, but they've started to empty out some of their treasuries. We saw this from Cathedra and a few other of the more larger publicly traded miners. But one of the metrics that I like to use to basically see, what is the status of miner capitulation? Is it happening, or are miners, turning on machines on net? Hash ribbons basically just shows the 30-day moving average of Bitcoin's hash rate and compares it to the 60-day moving average of Bitcoin's hash rate. And when the 30-day moving average dips below the 60-day moving average, it's basically a sign that, hey, hash rate on net is turning off. So that means these older gen rigs, typically like S9s, are just, their break-even prices are too low for wherever they're located. So operators are, turning off their machines and unplugging them and trying to sell them if they can find a buyer. Another thing, so it's not just necessarily old machines. It could be newer gen machines that maybe have very high electricity costs. They're also turning off, or people that leveraged up, all throughout 2021. A lot of, which I'm going to get into in a second, a lot of publicly traded companies and even more private companies, mining firms, really, leveraged up to the hills last year when times were good. ASICs, new gen ASICs were selling for, 10,000 plus, and now we're seeing like S19s trade at 3,000, 4,000. So when you use capital, or when you borrow capital to buy rigs, and that collateral falls by more than 50%, obviously you're going to have some major issues. So especially making your interest payments. But there's been some really great analysis recently on how much leverage exists in the Bitcoin mining industry. Basically, the Block Research did some posted this chart on Twitter, posted in the newsletter for you guys to see. But basically, they kind of showed that of the top publicly traded miners, I think there's basically 11 of them, they have about $1 billion in loans payable. So this is debt that is secured by Bitcoin, ASIC miners, and just mining infrastructure. So at a quick glance, this 1 billion figure kind of seems to be contrasting with what Bloomberg actually reported, a few weeks ago. But Ethan Vera, who's great guy, he's chief economist and operating officer at Luxor. He actually mentioned that there are many more private miners, even that took out debt in greater size than those public companies. And last time Luxor ran this analysis, public companies were less than a quarter of the overall market for Bitcoin mining debt. And so Ethan was basically saying that, hey, yes, there's about $1 billion in loans payable for publicly traded companies, but there's actually about $3 billion worth of loans payable for private companies as well. So the Bloomberg report that came out by David Penn was actually extremely accurate, very well done, and it the $4 billion number was very accurate, and it's kind of a sign that, hey, there's a lot of leverage still tied up in the Bitcoin mining industry, especially in North America. And if prices do go lower, a lot of these miners are going to have to capitulate. They're going to have to capitulate their Bitcoin. They're going to have to capitulate their treasuries. They're going to have to capitulate their mining rigs. And so it kind of could add on to the existing miner capitulation that I talked about earlier that's been happening over the last 24 days or so. And it could add on to the problem. But too early to tell if we go significantly lower or not. Another thing that I covered in the newsletter this week was something that Sean Connell, who's VP of Power at Lancium, posted on Twitter. And it was basically S19 Pro Miner Breakeven matrix that basically showed that over the past 8 months, the break-even price of an S19 Pro has dropped by 75%. So miner margins is just another example of how compressed miner margins are getting, over just the last year. And like Will said at the beginning, it's because one, Bitcoin prices dropped significantly, but two, since last year, hash rate is still growing. Like it's not, it's definitely not growing at the pace that many analysts expected that who made projections at the beginning of this year. I remember most people were calling for over 300 exahash, at the start of 2022. Right now we're about 210 exahash, or at least the 14-day moving average of hash rate is right now. And so we're definitely most likely not going to get anywhere close to 300 exahash this year. And a lot of that's just due to, price and hesitancy when deploying capital into the mining industry, especially over the last, 5 months or so. Last thing I want to cover for mining specifically is Samsung. Actually, this was reported by The Elect and Bitcoin Magazine as well. They reported that Samsung is starting a trial production of its 3 nanometer chip. And they actually have one customer in line, or at least their first customer in line is a entity called PanSemi, which is a subsidiary of MicroBT. And if you guys don't know, Bitmain and MicroBT are the 2 top Bitcoin ASIC manufacturers right now. And a 3 nanometer chip would be top of the line right now. So what does that mean for existing Bitcoin miners? It's nothing like too unexpected. This new chip will obviously be more powerful and more efficient than the current top of the line ASIC, which is the S19 XP made by Bitmain, which is actually coming out this month. But unlike ASICs that were released around 2013, this new chip won't make all other chips completely obsolete. It will be more powerful, like I said. It'll have better operating margins, but it will continue to be in line with the idea that ASICs, these the chips that are used to mine Bitcoin, are commoditizing. So while this is a new improvement, it's not like an unexpected game changer for miners. It's just kind of par for the course at this point. And whenever it does come out for industry players, it's always a good idea to at least consider upgrading to the next gen machine, depending on what the price is. But yeah, that's it for mining this week. Definitely interesting times, and we'll continue to monitor this miner capitulation that's in progress. And if price goes lower, it'll probably get worse. But if it doesn't, maybe it'll end soon. So we'll see.
Great stuff, Joe. If anybody joined late, make sure to check out the newsletter and you can get the full breakdown. And I know sometimes it can be a little difficult to understand if you're not looking at the charts and you're just listening. So make sure to go look at the newsletter and find out more about what we're talking about. Will or Blake, you guys got any more comments before we wrap up here?
No comments from me. Just hope everyone, all the Americans in the audience, have a good 4th of July and great weekend.
Yeah, thanks for everyone for coming in, and we'll talk to you guys next week.
Yep.
Make
Thanks,
sure to zoom
everybody.
out. Keep holding, everybody. We'll get through this.
We're going to make it.
Happy
Thank you,
4th,
everybody.
guys. See ya.